Hi everyone, today we're going to talk about Cisco's Q3 2026 earnings. 90 days ago, Cisco told investors it would book $5 billion of AI infrastructure orders this fiscal year. Today, it raised that to 9. Cisco doesn't sell GPUs, it doesn't train models. It sells the gear that connects them, and the trade just got bigger. Did the rest of the print back it up? Let's open the books. 6 numbers, revenue $15.8 billion, up 12%, Cisco's biggest quarter ever. Non-GAAP earnings per share $1.06, up 10. GAAP earnings per share 85 cents, up 37. And that 37 is doing real work because a chunk comes from below-the-line investment gains, not operations. Non-GAAP operating income hit a record $5.4 billion. Operating margin held at 34.2, above the guide midpoint. $2.9 billion returned to shareholders, 87% of free cash flow. Top line and operating leverage both strong. We'll get to the asterisks. Total product orders grew 35% year over year, a huge number, but split it by who's buying, and the shape of the business changes. Enterprise plus 18, public sector plus 27, and service provider and cloud, which contains both hyperscalers and telcos, up 105%. Driven by the hyperscalers inside it. One customer cohort carried this quarter's order growth. That single number tells you the shape of Cisco's next 2 years. Cisco's portfolio splits 5 ways. Networking, switches, routers, wireless optics is 56% of revenue and where essentially the entire AI infrastructure story lives. Services is 24%. Security 13%, that's where Splunk landed. Collaboration 6, mostly WebEx. Observability 2, Silicon 1, Acacia Optics, data center switches all roll into the networking line. The other segments matter, but they're not what's moving the stock today. Cisco stock re-rated 60% in 12 months. Earnings only grew about 10. The market repriced Cisco from ex-growth network hardware to AI infrastructure beneficiary. Compared to Arista at 30 times earnings, this isn't extreme. Compared to where Cisco's traded for the last decade, it absolutely is. The question this print has to answer is the AI thesis real enough to hold the multiple? Hold that question. Every later slide is evidence one way or the other. Now to what actually printed. Short version. Cisco beat its own guide on every line. A clean beat on every line. Revenue $700 million past the top of the range. EPS 7 cents past the high end. The number worth flagging is gross margin. 66 is the midpoint of guidance, but it's down from Q2's 67.5. That compression is the structural story for the rest of this video. Here's the number that explains how a midpoint print on gross margin still produced record profitability. Non-GAAP operating income, $5.4 billion, is the highest in Cisco's history. They got there even with gross margin compressing 2.5 points year over year. How? Non-GAAP operating expenses grew 5% while revenue grew 12%. That's textbook operating leverage. Revenue outpacing cost growth. Whether it's repeatable depends on whether the cost discipline survives the restructuring announcement they made today, which we'll get to in a minute. Before the segments, here's the whole income statement in one picture. $15.8 billion in, $3.4 billion lands in net income. That's 21 cents of every revenue dollar, the highest Cisco's printed in years. The sankey shows where the rest went. $5.8 billion to cost of goods, $2.9 to sales and marketing, $2.4 to R&D, $670 million to tax. $80 million of net other income. Investment gains net of interest, adds at the bottom. The cleanest version of an income statement you'll see this quarter. Flip to the revenue side, 5 product groups. One of them is doing all the work. 5 segments. One is doing everything. Networking grew 25% year over year. That's about $1.8 billion of incremental revenue from one product line. Security was flat. The Splunk cloud subscription transition continues to drag revenue, while the core security portfolio quietly grew double digits underneath. Observability, +3. Services and collaboration each down 1. Back out networking and Cisco's growth is roughly 0. The engine is running on one cylinder. The question is whether that cylinder is durable or whether it's a 1-year AI order spike that flattens out the moment hyperscaler capex stops growing. Networking product orders grew more than 50% year over year. That's the order pipeline that becomes revenue in the next 2 to 3 quarters, and it's the 7th consecutive quarter of double-digit order growth in networking. Not a one-quarter anomaly, a sustained pattern. Campus refresh on one side, hyperscaler AI buildout on the other, industrial IoT compounding underneath. Networking isn't recovering. Networking is in the middle of a multi-year upcycle. All 3 regions grew in revenue. Americas leads at plus 14. That's where the Hyperscalers headquarter. EMEA and APJC each plus 9. On the order book, the order flips. EMEA leads with plus 39, Americas plus 35, APJC plus 25. Americas leads on AI revenue today. The order pattern says the campus refresh and the international enterprise business are just as broad. Not just hyperscaler concentration. Here's the disclosure that matters. Total product orders grew 35%, but Cisco explicitly told you, back out hyperscalers, and the number is 19. Service provider and cloud, which includes both hyperscalers and telcos, was up 105% in total. Hyperscalers within it grew triple digits. Telcos grew 9. Enterprise was up 18, public sector 27. The headline 35% number is not the run rate. The run rate, if hyperscaler order growth normalizes, is closer to 19. Still a strong number, but it's not 35. This is the line of the print most worth remembering. If the hyperscaler line is the print, let's go inside it. What are they buying? And how big can it get? $2 billion of hyperscaler AI orders in all of fiscal 2025. $1.9 billion this quarter alone. But Q3 slipped sequentially, 2.1 down to 1.9. Worth flagging. To hit the new $9 billion target, Q4 needs $3.7 billion, roughly double Q3. The raise puts very real pressure on the next 90 days. If Q4 lands below 3.5, the thesis gets reopened. 3 pieces underneath the AI order line. Networking systems, or the actual data center switches, saw orders grow more than 40% year over year, and Nexus switches, tagged for AI deployments, grew nearly 50% sequentially. Silicon One, Cisco's custom ASIC, picked up 3 new design wins this quarter, 2 P200 scale-across deployments and 1 G200 scale-out, all at hyperscalers. And Acacia, the coherent optics business that connects data centers over distance, took more than $1 billion of orders in Q3 alone and is on track to grow over 200% year over year for the full fiscal year. 3 layers, each one independently growing. Together, they're the picks and shovels. Year to date, 3 quarters in, Cisco has taken $5.3 billion of AI infrastructure orders from hyperscalers. Already past the $5 billion they expected for the whole year a quarter ago. On top of that, they broke out for the first time another $900 million of AI orders from neocloud providers, sovereign AI customers, and large enterprises. That category wasn't separately disclosed last year, but with triple-digit year-over-year growth in every quarter of fiscal 2026, the base was small, not nothing. A new pipeline forming behind the hyperscaler one. If it scales, the customer concentration question gets much smaller. Now to the asterisks. Cisco's are visible in 3 places: gross margin, free cash flow, and $1 billion restructuring charge they announced today. Year over year, non-GAAP total gross margin compressed 260 basis points, from 68.6 to 66. Product gross margin compressed 330 basis points. Services improved slightly. The driver is mix. AI networking gear sold to hyperscalers carries lower margins than enterprise switches sold through channel partners. A structural reality of the customer mix, not a one-quarter accident. Tariffs added some pressure on top. The remarkable part is the bottom line. Operating margin only fell 0.3%. Non-GAAP operating expenses grew just 5% while revenue grew 12%. And that absorbed essentially the entire gross margin hit. Operating leverage saved the print. That trick works once. It can't work forever. The walk is clean. A year ago, in Q3 FY25, operating income was $3.2 billion. Gross profit grew $800 million. Revenue growth overwhelming margin compression. Operating expenses grew $44 million on a $6 billion base, essentially flat. Net result $3.96 billion of operating income, up 24%. The reason it looks great isn't that anything got dramatically better. Cisco spent the same money and made 12% more revenue. That's it. GAAP net income grew 35%. GAAP operating income grew 24%. That's an 11 percentage point gap that didn't come from operations. Where did it come from? $344 million from a swing in other income net, driven mostly by $263 million of gains on investments this quarter, versus a $57 million loss the year before. Roughly $320 million on a single line, a mark-to-market on Cisco's strategic investment portfolio, not a recurring source of earnings. Net interest essentially flat. Higher tax took back $210 million. Cisco's non-GAAP measures back the investment gain out, which is why non-GAAP EPS grew 10, not 37. The 37 is real GAAP earnings. The underlying operations grew 10. Keep the distinction. $2.9 billion returned this quarter. The donut shows the split. 1.7 in dividends, 1.3 in buybacks. Here's the line worth scrutiny. Cisco bought back stock at $80.28. A year ago, they were paying $49.56, same dollars, fewer shares, much higher price. Buybacks at higher prices are mathematically less accretive. That's just math. $9.6 billion of authorization remains, but if the stock keeps re-rating, the dollars do less work. Here's the line the press release didn't headline. Operating cash flow this quarter was $3.8 billion, down 7% year over year. Net income was up 35%. So how is cash flow down? Three things. Inventory built up by almost $800 million in the quarter alone, on top of about $700 million earlier in the year. The $263 million investment gain is non-cash, so it boosts net income but gets backed out of operating cash flow. A roughly $320 million drag year over year on that line alone, and year to date, cash paid for taxes is up nearly $1 billion. Those three together more than offset the net income tailwind. The inventory build is intentional. Cisco is buying components ahead of the AI order ramp, locking up supply before Q4. That's a bet, and bets cost cash up front. The next slide shows just how big a bet. Inventory purchase commitments, the dollar value of components Cisco has agreed to buy but hasn't yet received, went from $6.3 billion a year ago to $10 billion last quarter to $16 billion this quarter. They've nearly tripled in 12 months. Management is buying the chips, the optical modules, the boards, ahead of the AI shipment ramp. They have to. Hyperscalers don't accept "we couldn't get the parts" as an excuse. The cost is that cash flow looks soft right now. The payoff, if the orders convert, is that the supply chain is ready. The next 2 quarters of cash flow will tell you whether the bet was the right size. Same day, Cisco raised guidance. They announced a restructuring of up to $1 billion. $450 million hits Q4. The rest comes in fiscal 2027. Stated purpose, free up investment for key growth opportunities: silicon, optics, security, AI. In plainer English, severance in the legacy parts of the business so headcount can be added in the AI parts. The pairing is unusual. Companies don't typically announce a $1 billion restructuring on the same day they raise guidance. The signal is that even with a record quarter, management thinks parts of the cost structure are still misaligned with where the growth is. Watch how the workforce mix shifts over the next 2 quarters. That's where the strategy becomes visible. What management thinks the next 90 days look like, and what they've raised the bar to for the year. For Q4, guidance is $16.7 to $16.9 billion in revenue. Another $1 billion sequential step up, roughly 14% year over year. Non-GAAP earnings per share guide is 116 to 118, 12 to 13% growth. Gross margin guide is 65.5 to 66.5, still compressing slightly year over year. Operating margin holds in the 34 to 35 range. The big sequential revenue jump is almost entirely the hyperscaler AI shipments converting from the order book. Q4 is where the picks and shovels story has to actually deliver revenue, not just orders. Look at the pace of the raises. At the start of fiscal 2026, Cisco guided revenue to about $57 billion. Today's number is 62.9. $6 billion added to the top line in 9 months, bigger than the entire annual revenue of Arista. The original AI order framing was about $1 billion. The current number is 9. And earnings per share, raised again today, is now 427 to 429. 2 raises in 9 months, each one material. Either Cisco started the year being conservative or it's discovering the size of the AI opportunity in real time. Whether they hold the multiple a year from now depends on whether they can do this again. One thing not in the headlines, but absolutely in the guidance, is tariff drag. 10% on most countries, partially offset by a semiconductor exemption. 10% on Mexico and Canada for non-USMCA components, plus the smaller copper, steel, aluminum tariffs. Management has done the math on the current regime, and that math is already in the Q4 gross margin guide of 65.5 to 66.5. The risk isn't current tariffs. It's escalation. Cisco's shown it can pass through cost increases without losing share, but that's a margin question, not a volume question. Watch this. Verdict. Framed as conditions, not a scoreboard. The bull case requires certain things to be true. The bear case requires others. Map this quarter's evidence onto each. 6 conditions for the bull case. 1. AI orders sustain at $9 billion plus annually, not just FY26, but for years. 2. Silicon One wins widen beyond the current 3 hyperscalers. 3. Acacia 800 gig adoption broadens beyond one customer. 4. Campus refresh runs multi-year, already in motion. 5. Gross margin stabilizes as the mix shift settles. 6. NeoCloud, sovereign, and enterprise AI scale that 900 million pipeline 5 to 10 times. All 6? Multiples justified. 6 conditions for the bear case. 1. AI orders are front-loaded. Hyperscalers race to build out, peak in FY26, then the curve flattens. 2. Gross margin compression accelerates as hyperscaler revenue share crosses 40%. 3. Free cash flow stays soft, the supply commitments don't convert. 4. Hyperscalers go vertical, partnering with Broadcom and NVIDIA on their own switching silicon. 5. Splunk drag keeps security flat. 6. Tariffs escalate from 10% to 20%. All 6, multiple compresses. This quarter's evidence on each. Bull case. 3 clear validations. AI order ramp, Silicon One wins, campus refresh. Bear case. 2 clear validations. Gross margin compression and cash flow softness. 3 conditions stayed yellow. The new NeoCloud pipeline is real, but small. Splunk integration is still a question. Hyperscaler verticalization is a long cycle risk. Net. This quarter moved the dial toward the bull thesis. It did not eliminate the bear risks. The multiple is still on probation. That's the print. Cisco delivered a clean beat on every line, raised its AI order target by 80%, and demonstrated genuine operating leverage. It also showed gross margin compression, soft cash flow, and a $1 billion restructuring that was paired, unusually, with a guidance raise. The valuation has moved well above Cisco's historical multiple. Whether that re-rating sticks depends on whether the picks and shovels narrative is a multi-year structural story or a one-year spike. Today, the bull case got more validation. The bear case didn't disappear. The next 4 quarters answer the question. That's the verdict on Cisco. But tech earnings season never really stops, and the next breakdown is already in the works. On this channel, you get every major tech print broken down the same way. Numbers first, narrative second, plus cross-company comparisons in between, so the picture stays connected. Hit subscribe so the next one lands in your feed. See you next video.